In today's risk transfer environment, the biggest challenge in using blanket additional insured endorsements is the increased scrutiny on the underlying trade contract that requires the additional insured coverage in the first place. And the reason for that is historically the additional insured coverage has been triggered simply on the presence of a contractual requirement that there be additional insured, or AI coverage as it's called, and that's sort of where the analysis stops. At that point, the additional insured has access to the policy, and the coverage is analyzed as if they were the insured on that policy. What we're seeing nowadays is that there has been, because that dynamic, the historic dynamic, has been subject to some manipulation from time to time, and people perhaps getting access to more coverage than the parties originally bargained for. There's been an evolution of the standard policy forms, the blanket additional insured forms, to put more of an emphasis on the terms of the trade contract. And I think that evolution can be a little bit surprising to some people. It's not something that is immediately apparent, but is a critical component of modern additional insured analysis. So what winds up happening is that, especially with the Insurance Services Office's standard additional insured form that's in circulation now, the language refers to the trade contract in a lot of very specific ways, in some ways which haven't been fully tested by the courts. And from a policyholder coverage counsel's perspective, that's troubling, because it means I can't tell my clients with any degree of certainty, this is how this is going to play out. And so what it really requires is that the savvy additional insured, and really even the party that's providing the additional insured coverage, is very closely paying attention to the terms of the trade contract as it relates to the insurance requirements, knowing that there's a possibility that those could have a direct impact on the coverage that's available to the additional insured. And it really is both a concern for upstream parties, the parties who would be getting additional insured coverage, and the downstream parties, the parties who would be providing additional insured coverage, because if you're the upstream party and you're trying to get additional insured coverage and it doesn't function the way you expect, you're going to be a little perturbed. And on the other side of that equation, if you're the downstream party, you might be saying to yourself, well, knowing I'm savvy to the way additional insured endorsements work nowadays, and maybe I can take advantage of that and get something a little more than I bargained for, protect my corporate program from a lot of additional insured claims. But the practical reality of that, of course, is you might wind up with a lot of upset clients. And so I think what it requires is that the parties to the trade contract really have to, more so than at any point in the history of this particular type of dynamic in traditional risk transfer, understand and be upfront about what the expectations are, and make sure that the language of the trade contract accurately reflects that. Knowing that the additional insured endorsement is likely to tie in very closely to what those requirements are.